Hey everyone, we're letting the last few people trickle in here. So you got a handful of you ready to go. This is my new assistant. His name is Mowgli. We just rescued him, my fiance and I. He's 11 weeks old. He's been with us for about a week and a half. He's a, of course.
He's a terror? Is that what you were going to say,
Yeah.
Paul? He's a terror?
He's a little bit of a monster. I'm glad I didn't lose the broadcast there. Are you guys, you still with me?
Yeah.
That'll be a fun little blooper reel. All right, and we're back. So you guys just met Mowgli. He's doesn't really like to sit still very well. I was just starting to explain. He's a half Louisiana Catahoula leopard dog, which they're kind of a wild bunch. They're supposed to be working dogs, pig hunting dogs in particular. They were bred by the Choctaw Indians to hunt pigs in swamps. So he keeps our hands full. The other half is Border Collie and Blue Heeler, which are also both working breeds. So if for whatever reason I go dark or something like that, I'm probably just chasing the guy. He's actually got something in his mouth right now.
All right, so we might as well go ahead and get started. I know we had some questions we did have some questions to start out.
Yes. And we still are waiting on just a couple more people. So
Okay.
I'll keep running after the guy. Sorry about that. Never a dull moment around here. He just woke up from a 2-hour nap, and that's always kind of his feisty time. So I'm trying to bribe him with treats and stuff. Come here, bud.
Okay.
Yeah, he was eating a Post-it note when I ran away.
See what time it is here, 10:32.
I'll give people about 1 more minute.
Okay. Well, I'm glad everybody could join us. I think we have some pretty good topics. We've had a few questions. We'll get to those. And just kind of the general. One question that wasn't asked that I wanted to talk about, guys, is I've gotten a lot of questions of how come the market goes up, even though we have all the civil unrest.
That was actually one of the questions we got during the registration. So that's great. You got there.
And then Daniel and David, in our last just in-house meeting, we were talking about kind of how people behave, the herd mentality. Daniel's been doing some reading on that. And yeah, you're still signed up, or are you still in that course to try to understand? I forget what it was called.
Yeah, it's so there's a certified financial therapy designation. It's pretty new, so I'm holding off on actually getting the designation, but I have done all the videos, and actually one of the fathers of financial therapy, I recommend everyone reading this book, and I'm in the middle of reading it too. And it really, I said, if anything, it makes you a little more sympathetic towards clients and towards people in general, because what you learn is that so much of how you react to markets is what you learned as a child. And I always thought it was funny when my dad was like, well, you were hearing about the stories of the Great Depression when you were under the table and this and that. And it actually scientifically is proven that those type of stories stick with children into their adulthood, which will make you react certain ways. So I just find the whole thing fascinating.
Yeah. All right, Paul, you want to go ahead and?
Yeah, I guess that was really kind of the sentiment of the first question. How come the market doesn't even seem to notice the civil unrest across the country? It seems like the market still had a pretty strong first couple days to this week. Can anyone reconcile that?
Well, if you go look back historically, one of the things that always confuses people that, they have some of their money invested in the stock market is why it behaves the way it does so often. And they see bad stuff happening and they wonder, how does the stock market go up when bad news is coming out? And I don't think it's ever about, and I think this really confounds people. It's never really about, is something good happening or bad happening? Is it getting better or is it getting worse? And kind of as a discounting mechanism, just like a lot of things, all this economic turmoil, what we had before all the civil unrest, it looks beyond that. And it says, where are we going to come out of this? And it never focuses on looking at the bad stuff that's happening. It's is it going to get better? Sometimes you'll hear a company had bad earnings, but the stock price went up. Why? Well, they were better than people expected, even though they were bad. That's kind of the main point. And we could go back to, I'm a little older than the boys, obviously, but you think, and I was a little boy at the time, 63, the Kennedy assassination, and then you had Martin Luther King was assassinated in 68. So we had a lot of turmoil then, politically, racially, and then you could even go to the other King, I guess, Rodney King. The guys don't know that, but pretty severe riots and civil unrest back then. And then we had Ferguson more recently in 2014. But the lesson, when you go back and look at how the stock market behaved, it's clearly a lesson of saying really didn't behave that badly. If anything, it tended to have what it always has, a bias to the upside. So I think it's just one more indication that the stock and bond markets, for that matter, markets are always looking forward and discounting the future. And the real debate is about, are things getting better or worse at all times? And that's a tug of war. It's a psychological tug of war. And of course, the billions of overlapping minds will disagree on the spectrum of better or worse, which is why we get a lot of volatility, because there is no truth. It's just the market's consensus of everything's getting better or worse.
Well, and don't you think too, I mean, the rioting and looting that's going on, that's just one thing that's happening in the world, and not that it's not a big deal, just from a world standpoint or a country standpoint, but there are a lot of things that impact stock prices. And I think, maybe other variables are doing well, or like you said, maybe economically things are not as bad as what people expected at this point. So that's causing the market to go up. Like, it's never going to be one variable or one headline that's going to drive the stock market performance on any given day, month, or year. There's, the stock market is basically the aggregate of the value of every company across the globe. That's not going to be driven by, one thing. It's going to be driven by a whole bunch of different things that are going on across the globe, impacting each company differently.
Yeah, I think if we start getting letter bombs like we got in 1919, we had big riots in 1919, and the market still kept going up until there were being letter bombs, and they had what was called the Red Scare, all the communists and the anarchists back then. Then the market took a deep dive. But if these riots continue and go to that level, then I would expect it to have some immediate impact. So in the short run, the stock market is a kind of a psychological machine. In the long term, over our lifetimes, it's a weighing machine. It's just weighing the future, weighing the earnings potential in the future.
And then kind of the second half of that question was, I'm just curious about what I should do, or should I do anything? I think I have an intuition for what the answer is going to be, especially Dave, who's been kind of talking about the temptation to market time.
Yeah, if you want me to just, I'm going to sound like a broken record, but there's really nothing to do. By the time you know about something, the market's already accounted for it. It's too late to do anything about it. At the end of the day, too, it's like making investment decisions based on headlines is just never a good idea.
Yeah.
Well, actually, go ahead.
Psychology, does that related, Daniel and David, to what we were talking about, of kind of why people kind of react to these things in herds, or, is it greed, is it fear, or is it something else going on?
I think it's really just the fear of missing out. A lot of people say that, it's greed that caused these things, like 2008 and things like that. But a lot of it is truly the fear of missing out, because you don't want to see your neighbors making more than you do, because that actually like physically hurts you and mentally hurts you. So you go, well, I need to get in on that. So as markets rise and you're saying, I'm missing out on these returns, someone is getting these returns, but I'm not, then it just snowballs on itself. And I think that's kind of what we're seeing a little bit now, is because I think we can all vouch for this. I didn't really hear anyone asking me about contributing more money to equities about a month ago. And now that it's starting to pick back up, you're starting to hear it. So although
Daniel anticipated our next question, but keep going, sorry.
Yeah. But although it's not a market timing issue or anything like that, it's just psychologically, it's really hard not to try to draw conclusions and try to get that return that you think is going to come, even though it may not, or it will. But, you just truly don't know. And like Dave said, it's not something that you can actually make an investment policy statement off of, is market timing or anything like that.
And that's actually a really good segue into our next question, because I think there's actually two questions in here. You know, we're not really concerned, this is the question now, we're not really concerned about our retirement situation, but we're more concerned about increasing what's left to our children. You know, is now the right time to move money from bonds into the stock market while prices are still low? So I think there's kind of two questions there. You know, one, is a permanent allocation shift okay, you know, to go more equity, so maybe your inheritance get more. But then there's also the question of, should we do it now? Is now the good time? So does one of you guys want to take either of those questions?
I'm gonna let you guys finish it, but there goes that market timing. I think clients don't recognize, and being human, welcome to the human race, there's always this undertone of, is it a good time? Can you tell me what the market's going to do? But I'll let you guys take a stab at that. How client walks in and asks you that, what's kind of the methodology you guys would use? What's that conversation?
I'd start off by walking through the financial plan that we've built for our client to make sure that we have covered all the spending needs and living goals and hopes and dreams within the plan first. And if we have that essentially locked into the plan, then I would look at, well, what if we addressed a higher equity position for the sole benefit and exclusive purpose of my children or grandchildren down the road? And what does that do to the plan? What is the financial impact? Does that mean reduce spending now? Does that mean no impact on spending? And we, as Paul often says in meetings, we just price the information, and it's not so much a personal opinion on our end as much as it is a data finding mechanism. And we say, given this set of criteria for needs of money for your living expenses and your goal to potentially leave an enhanced amount of money to your kids, it's by no means guaranteed, but you can seek it out by potentially targeting a little more equity or stock holdings. This is the impact on your plan. And as always, it's just, it's a personal preference, and it doesn't mean it'll show up necessarily, but we can model fairly well in our software by looking at a timeline of 1,000 different lifetimes, and it's a spectrum. And we say, we don't know which one of these 1,000 scenarios may show up, but it gives us a pretty good idea, and we can make informed decisions on that.
I think it also, just let me add there, it really depends on at what age are we having this conversation. If it's the 62-year-old newly minted retiree, I might have even a different conversation than someone who decides at 80, you know what, we're never going to spend this money. We really want to leave it, more of it for our kids. Might be two really different conversations, and it really comes down to, as Ryan said, you price these things. And I'm starting to think, and the boys and I have been talking about this based on some new research I've been doing and some programming I've been doing, that I'm not so sure that how much we leave our people or institutions we dearly love, how we endow them, should all be globbed into one thing. I'm starting to think we might want to separate these out, and it gives you different answers, and that really prices. Okay, that's what you want to do. Let's almost strip it out of the plan and put it in a bucket just for that, and then that's going to determine, okay, what price are you really paying? Is that going to have any impact on your lifestyle? Most of the time it doesn't, but it sure can, depending on what age we're talking about.
So I guess the short answer is kind of, don't make a market call out of it, but if you consult your plan and you see that a permanent allocation shift is more likely to achieve the goals you want, then that's okay.
Yeah, and I'll add to that. Let's say this was 20 years ago and somebody asked that question. You would think that having done that then, 20 years of time, we always think of stocks compounding at 10 to 12% per year, whether it's large stocks at 10%, small stocks at 12%. We set this nice plan up, assuming that it's almost a given. It would have increased the amount you have today because of that shift, but a lot less than it was one of those bad distributions. We've had one of the lower 20-year returns for the stock market, the broad U.S. stock market. I won't include that in the globally diversified portfolios have done much better over the last 20 years. But there's never a lock. And I think people really struggle with probabilities. People really they want certainty, and it's never there. And people really struggle with this, putting the odds behind our back and trying to form expectations can get really tough. But the short answer is, yeah, you can gear any plan to be targeted towards a larger legacy at the end. It's just, what are you willing to put up to maybe get that outcome that you're after? And I think that's just a more complete conversation. But as far as market timing, if you were going to do that and you asked me, probably any of the guys, when should we do it? We'd say, well, if that's really your goal and you're committed to doing that, today by 3 o'clock is probably the best answer.
Yeah, I think that's kind of the final word on that one. So here's another concern that we've been getting a lot of is inflation. And this one in particular is referencing, inflation that we've seen in gold and platinum prices. And Pops, I know you've talked a little bit before about how gold might not necessarily be the best inflation hedge because it's so volatile. Could that be kind of the same issue for reading too far into swings in gold prices to anticipate inflation?
Well, maybe. We're in this grand experiment. Really, I would say it's fair to say it's unprecedented. Basically throwing the kitchen sink in another kitchen sink from the Federal Reserve and the Treasury. And that's got a lot of people wondering, are bond buyers, the people that fund our deficits, willing to take these low rates for a long time? And so you kind of keep your eye on the US dollar and gold and how those two things are behaving. They're a pretty decent barometer of market expectations and willingness. If the dollar starts collapsing, and there's people have concern on that. Well, I'm not thinking of collapsing like the guys on TV talking about it collapsing. I'm talking about just the dollar really starts to weaken. One of the things the Fed would have to do is begin to hike interest rates a bit. And of course, it also becomes inflationary. So there's scenarios there, but I think we know the Fed targets 2%, right? They want prices they want the currency to be, I'm just gonna call inflation 2% a year is their target, okay? And so with that as a target, we just don't know if everybody's afraid. Not everybody. There's a lot of people that have this fear right now. I find it's a very common fear. Sometimes it's fed by people that have an interest in feeding that fear, but you try to connect too many dots that probably shouldn't be connected. But remember, after 2008, 2009, we heard the same things. Swelling of the Fed's balance sheet, all this printing of money, and we're doing some printing of money. Guaranteed we're going to have hyperinflation and high inflation. Never got it. Maybe we'll get it this time. I doubt it. And I do hope that, frankly, over the next few years, I hope we have a little higher inflation. That means we came out of this thing just fine.
Well, and you said, a lot of people are expecting high inflation, but the market doesn't seem to be. So one of the things you can look at is, as you said, part of a bond's interest rate or a bond's yield is inflation expectations are baked into that. So if inflation expectations were really high among bond investors or professional investors, interest rates would be a lot higher right now, especially for intermediate to long-term bonds, and they're still pretty darn low. So that just tells me that just by its very nature, inflation expectations as priced by the market, which is really our best estimate of future inflation, are not that high. You can try to even isolate that inflation expectation component by looking at the difference between Treasury inflation protected securities, which basically perfectly hedge inflation, and then what are called nominal Treasury bonds. So they're both Treasury bonds, so it eliminates any sort of credit or default risk. And the difference between those two, theoretically, in theory, should be the inflation expectation that the market has at any given kind of term for those types of bonds. That spread's not super wide either. So if you just look at what the market is pricing in, it's not pricing in high inflation. That's not me saying it's not going to happen. It's just saying, look, that's probably our best guess, but really at the end of the day, we don't know. And Fred Gertz, who's a PhD in economics, we talk about this on our show because it just keeps coming up with client questions. And he, his comment was, I'm not too concerned about it in the short run. It may happen in the long run, but even he, it's like, I'm not 100% sure exactly how it's going to play out, and I don't think anyone is.
Well, for sure. Also, so the market right now, so the people on the planet Earth that are most sensitive to interest rates and inflation are bondholders, right? And you got this, and the bond market is much larger than the stock market. I don't think most people are aware of that. Much larger. In other words, what Dave's saying is, if you look at the difference between when the Fed created, in my opinion, Treasury inflation protected securities, that was basically the government admitting that their straight bonds are cancer, that they are going to devalue the dollar every year by a couple of percent per year, or just have general inflation. And that market, that's the most sensitive people on planet Earth to inflation. So any clients that are thinking or worried about it, or pundits, best way to do is go look at the bond market and see what people are actually betting their money. It's one thing to have an opinion. It's another thing when you're placing a bet of how you really feel. And I'm not worried at the moment. We'll know you'll kind of know it's coming when you see it. The dollar starts declining, commodity prices go up. You go, here we go again. Always keep in mind, inflation is much easier to deal with. Not easy to deal with, but relative to deflation, what people ought to really be concerned about. And the real question, really, I would think if there's a question about inflation and deflation, I think people should be more worried about deflation. I don't think it's coming, but without the aggressive Fed interaction, we could have easily tipped into a steep deflationary period. Those are very difficult to come out of. Possible, but really difficult to deal with deflation. So to the extent we get a little higher than normal inflation, the good old days of 3 to 4%, kind of long-term trend. In the late 80s, 89, 90, we had CD rates around 8, 9%, but inflation was running 5% or so, and then you had 30% tax brackets. So all these things are intertwined. We'll get market keys if we're headed for higher inflation. And if we do, then the next question might be, well, what are we going to do about it? And gold may or may be part of the equation. It hasn't been in mine for 36 years. I'm not saying it's impossible to create a hedge with that, but over one's lifetime, a really good inflation hedge has always been ownership in the great companies of America and the world. It might call for us to suggest a little bit higher, 10 to 20% higher stock market holdings compared to where they are today if we get inflation that runs above 4%. That would be my best, sitting here with all the research I've done. That's probably the most reliable cure for periods of a little higher inflation.
Well, guys, we're getting kind of to the end. Oh, Ryan, go ahead. You have something to say?
Yeah, I was going to chime in too, some of the rationale behind why stocks versus gold. Gold is a commodity, it's a product, it doesn't produce anything. Whereas investments in companies are companies that produce goods that we buy and sell. And historically, over the past 30 so years, the dividend increase is about 5.9% over that period of time. So it is by no means a lock, but it simply states that you can beat out inflation of 3, 4, 5% by buying and holding more ownership of stocks relative to bonds in your portfolio, because then you're going to be capturing more of that dividend payout that's paying out maybe more than the inflation amount is. So
historically, that's certainly been true, Ryan. That's a really good point. One of the best inflation fighters has been the dividends on the great companies of America and the world that have historically pretty much, there's no lock that that's what it's going to be in the future. But if we look down average decade by decade, pretty much double the rate of inflation. So that's another key component of why slightly higher stock market exposure might be part of that solution.
Well, guys, I was just mentioning we are getting sort of to the end of our questions here. So if anybody has anything else they want to ask, feel free to do that now. But one of the things I wanted to ask about was, anytime the market goes down, and recovers really rapidly. You know, I'm thinking back to 2008, 2009, that era. You know, people kind of think it overruns itself and they're kind of waiting for the other shoe to drop. Do you get that feeling right now, or do people think the market is, pricing everything fairly? What's your guys' take on that?
If you talk to business people, I was just talking to one of my pals that owns a company. My sense from the business community is a fear of another big shoe to drop. In other words, there's this kind of, and it doesn't really mean anything because it's not data, it's just anecdotal from business people, have this uneasy feeling of a lot of this stuff hasn't trickled through what most people are expecting. I'm not sure that's true, but that's kind of the feeling. It's always natural, and that's the recency bias, guys, that we're always fighting the last war, whatever it is. And, I think that part of that is just because you see this confluence of COVID and the restrictions and the uneasiness around business there, followed by, gosh, now that we can open in a lot of cities, they can't open, even in this town, stores are closing. It's certainly, I could see why anybody would adopt a feeling of another shoe to drop, but you always have to remember it's not just us 5 guys and the 14 or so people that are considering these things. It's the billions of overlapping minds that are looking out into the future. So there may or may not be another shoe to drop. From a stock market shoe to drop, I think if we get a really bad wave of COVID again in the future and it mutates and kind of takes another dangerous path, we'll probably go visit the old lows of March 23rd. I think absent that, probably not. David loved when I forecast the stock market.
Again, this is a scenario where you just have to say, if we're being honest, we don't know. And, I'm comforted by the fact that neither is anyone else. At least right. The evidence seems to suggest that even professional investors are not able to consistently predict what the market's going to do. And I like the example you brought up, Paul, of 2008, 2009. For years after that, you kept hearing, oh, there's another shoe that's going to drop. And then it caused so many people to miss out on literal, doubling, tripling of their money because they were waiting for that pullback and then didn't get it. And they got stuck on the sidelines for years. And so things can go horribly wrong when you start trying to time the market, and you can end up costing yourself a lot more money than you would if you were, investing, quote, too early and then experiencing a temporary decline. That's really, if your plan is reasonable and your portfolio allocation is reasonable, a temporary decline is something you can handle. It's not going to cause permanent long-term damage. But staying on the sidelines and missing out on a doubling or tripling in the market is going to just devastate you financially. And I think that's just something you have to always keep in mind is, look, there's always that possibility. And no matter what, there's always a possibility that the market can fall. So I'm not saying it won't or that the market's not going to fall. I'm saying we don't know. And you have to be psychologically prepared for declines at all times. But at the same time, you can't try to shift your allocation based on forecasts.
But you can understand, don't you guys get this feeling during these types of times? You fall 35 to 40% in your stock market portfolio. It recovers a big chunk of that in a short period of time that you're almost on this. People feel like, oh, I really don't want to go back down there. Is it even possible it could go up? I find that in one of the more challenging time periods is kind of in the midst of a bear market recoveries. And partially because history shows us that once you get into a bad bear market, whether we are or whether we're not in some long-term bear market, nobody knows, but you can have some amazingly powerful rallies, 40, 50, 60, 70% in those things, only to be disappointed 3 or 4 or 5 months later, you go down and take out new lows. It's not a forecast by any means of where I think we're going. The trick is mentally prepare yourself for disappointing returns for a while. May not happen, probably won't happen, but if they do, you're better to expect them and have a realistic outlook of, if I want the benefits the great companies of America and the world have provided my family and will continue to provide my family when I wake up on a cloud. If you're not mentally prepared for extended painful periods, you're never going to make it out. You're never going to make it out. But I will leave it my part of saying, when the guy showed me all the plans that we run for hundreds and hundreds of families, they're all in pretty darn good shape. It's probably an understatement. They're all in pretty solid shape these days. And so it's kind of one of those interesting bear markets that was really scary, but so far hasn't turned out to be dangerous. Big difference between, scary. Things can be scary, but they don't have to be dangerous. And it can work the other way as well.
Well, I think that's a great point to kind of wrap up here. Does anyone have anything else they want to say real quick before we sign off? No? Okay.
Anything from anybody?
All right, Bueller. No. All right, guys. Well, thank you everyone for being here. Thanks for bearing with me at the beginning when I lost my lost my screen a little bit because of the wild pup. I'm gonna go chase him around the yard now. We'll see you guys in a couple weeks. Bye-bye.
Yeah, we're here for everybody. Feel free to reach out at any time. That's what we do. And we're always happy to have that conversation. We never look at it like you're bothering us. That's the important thing to know. And I think I can speak for everybody on that one.
Perfect.
Okay.
Well, have a great week, guys.
All right.